All right, you want to start now or you want to wait a few more minutes?
I'm happy to start now. That would be
Okay.
great.
All right, so I'm gonna connect Facebook. I already signed in. Just one more moment.
Sure.
Takes a couple seconds to be live in Facebook.
Great.
Okay, I think we got so. All right, so hello everyone. My name is Celeste and I work at the New Haven Free Public Library in Ives Square. And today we have part 3 of this amazing series, Financial Planning Bootcamp, with Caroline Wetzel. Today we're going to be talking about financial health through investing. And thank you so much, Caroline, for being here again with us and giving us these amazing programs. I mean, they're like really, really good.
Celeste, thank you for this warm, wonderful introduction. It's such a pleasure to be with you again and with all of you through New Haven Public Library and Ives Square. Such a privilege to spend this time with you today. As Celeste kindly highlighted, this is experience number 3 of 4 that we're offering together, the Financial Planning Bootcamp. And hopefully all of you can see on your screen the cover slide of presentation slides I prepared for us today. As Celeste mentioned, my name is Carolyn Wetzel. And by way of reintroduction to those of you for whom this might be our first experience together, I am Vice President, Private Wealth Advisor with Procyon Partners. We're an independent fiduciary, which is important for you because that means your best interest, financial services company. By day, I help people develop financial plans and manage investments. And around doing that all the time, I enjoy offering learning experiences just like this. I haven't always been a specialist in financial planning and investment management. In fact, as part of reintroducing myself to those of you who know me and starting to get to know those of you who may be new, you see here a picture of my husband and me. This summer we'll be married 20 years. And very long story short, I was enjoying an exciting and successful career as a global corporate executive with an international financial services company. But very long story short, life didn't happen according to any plan either Scott or I had for us as a little family. Put most succinctly, we had multiple miscarriages. I gained a lot of weight and lost a lot of weight as part of numbing the pain. And I was additionally diagnosed with a condition known as alopecia areata universalis. I lost all my hair. So this is a wig, these are fake eyelashes. I chose to put on every day physically a look that was similar to how I used to look before the condition set in. The reason why I share this personal health story with you was because literally and figuratively, it was fertile ground for renewed rebirth from a professional perspective. It started my change in focus professionally from a global corporate executive in financial services to now a specialist in financial planning and in wealth management. I became a certified financial planner. I joined an independent team, Procyon Partners, some of whom you'll see at the bottom of the page. And at the top of the page now, as I mentioned before, I love doing stuff like this. I love sharing this information that I'm so passionate about with others so that we can all make thoughtful, intentional decisions today and over time with our finances. And to complement experiences like this that New Haven Free Public Library and I've Squared have made available. I also co-founded the Women Owning Their Wealth Collaborative, an informal network of people. So now that you know a little bit more information about me, what I would love to do is to dive into the content that we have prepared for you. As Celeste mentioned earlier, this is the third of a 4-part financial planning bootcamp series, and our particular focus today is the investing process. It complements the information we provided in April, first on what are the important financial vitals, the important components to keep in mind when it comes to your overall finances. And it additionally complements our last session, which is all focused on what is a financial plan and how do you create a plan for you. The assumption is that now today with this focus area, we're complementing those foundational principles with now beginning the investment process. So to get the most out of the experience, check out the recordings that are available online preceding today. And I'm delighted to present to you today our focus on investing. What will we do together as a group? There are 3 things I would like to achieve with you today. First is just review again. When we're talking about financial health and financial well-being, what is it all about? Like I mentioned, my whole focus is to help others understand their financial choices. We're going to recalibrate and reconfirm what this looks like for each of us. Second, I'll introduce essential ways to invest in you. And lastly, I'm going to share some investing strategies for enhancing your financial health today and over time. So as we begin, I invite any of you to reflect questions in the chat or comments in the Q&A. I'll do my best to address them as we progress through the material.
And I will be here to keep an eye on the chat or Facebook as well. So if anybody has a question, I can refer them to you. Yes.
Excellent. Thank you, Celeste. Excellent. So as we begin then, what is financial health and financial well-being all about? The key thing here to keep in mind is it's your ability to respond to today's demands and set yourself up for success over time simultaneously. So what does it look like? You see 4 dimensions as laid out by the Consumer Finance Protection Bureau. This is a government agency that's designed to help protect all consumers when it comes to their finances. The first component of financial well-being is having control over the day-to-day, the month-to-month activities related to your finances. Second, it's the ability to absorb a financial shock, the idea of the emergency savings and cash reserve. Third, it's being on track to meet your goals over the long term, to complement the initial immediate protection of yourself. And lastly, it's the idea of enjoying financial freedom. When you have the building blocks in place, you understand mechanically how it's working, you have the ability and the expectation to know that things will be volatile, things will be uncertain, but you are exerting a level of control where you can to set you up for success. And so the key takeaway here that I want to make sure we all hear loud and clear during today's webinar is that people with the very same level of income, comparable financial experiences, and maybe similar education may experience radically different levels of financial well-being because it's around their expectations and their behaviors in these 4 areas. Being financially wealthy does not mean living in a particular area code. It does not mean having a certain number of digits in your various investment accounts. It's your capacity to balance these 4 things today and over time. So if we take that as our framework, our way of thinking around financial well-being, why do people invest in the first place? Why is it so important? What you see relayed on the screen here are some of the most popular reasons cited for investing. For some people, it's the idea of building wealth over time. The idea being that with more wealth comes more opportunity. For others, it's the idea to hedge inflation. As we all know too well right now, the cost of everything from groceries to gas is significantly more than it was last year. And just imagine, over time, this will continue to be the case. So investing additionally may be to enable you to continue to be able to buy the things you rely on over time. Other reasons for investing may be to generate income, to complement income you already experience today, to have an additional layer of income available to you. Another style investing may be around minimizing taxes. You are offsetting certain expected taxes by reallocating and repositioning different monies or investments you have. And lastly, investing might serve a level of protection around the future. The reason why I bring this up is that in the same way financial well-being may look very different for each one of us around this webinar today, the reason why we are interested in investing may be very different too. And our reason for investing may be multiple at any given time. Maybe we're trying to build wealth and get a little extra income and do it in a tax efficient way. And depending upon where we are in our life stage, it may be more of one reason and less of another. Let's say, by way of example, perhaps it's focusing on building our wealth in our 20s, 30s, 40s, 50s, 60s, and then maybe it's around generating income in our 60s, 70s, 80s, 90s. The key thing to keep in mind here is that there are different reasons for the investing why. And across all the different reasons, what I want you to appreciate and understand is fundamentally, investing involves inherent risk. The investing process is effectively a trade-off. In exchange for, most often, cash in hand today, you are seeking out something new or different. Maybe it's more cash in the future. Maybe it's some more income now. But in making that trade-off, there is absolutely risk. There is risk that the amount that you begin with the investing process may go away. And there is possibility that between the time that you begin the investing process and you rely on using the investments that come out of the investing process, there could be dramatic highs and lows and volatility like what we're experiencing right now that may make the amount of money you are projected or trying to take out be different from what you were expecting. So the thing I want to emphasize in this moment is that investing absolutely serves multiple purposes for each one of us. And at the same time, there is inherent risk that is available that is part of this investing process. With regard to the investing process then, what do we do to begin the process in taking care of us? If we know that there's risk in the investing process, how do we even get started? The key thing I want to emphasize is that we need to begin with you. So on the right-hand side of the page, for those of you who are part of our last installment, you'll recognize right away what my team and I created as is the Procyon Financial Planning Pyramid. The idea being that over time, each of us is on different steps of our journey when it comes to our finances. The foundational or at the bottom of the pyramid might be around budgeting, saving, building our wealth. And as we have wealth available to us, we progress and then are looking around protecting and coordinating our wealth and ultimately giving our wealth to others. So if we take that kind of vision for what we're doing with our wealth as the framework for the investing process and what we're thinking about, then how do we invest in ourselves? The first thing that I invite and strongly encourage you to do is to invest and move cash available to you into emergency savings. We're always looking at all times to have, on average, 3 to 6 months of your day-to-day expenses in cash or cash-like equivalent. There is some kind of trade-off with this because we know if cash is available to us, it won't be invested in the markets for growth. But in this case, it's okay. There is that risk of not growth because we need that when or if life inevitably doesn't happen according to plan. To complement in investing in you in the immediate term, how do we invest in you in the intermediate term? Again, if we have this vision around how we are progressing on our financial paths or journeys, in the intermediate term, I want you to think about the policies and plans that are part of your overall finances. What kind of debt are you carrying and how are you paying it off? Are you utilizing retirement accounts, saving today for your future over time? They're valuable and attractive because growth you have in the account today is not taxed as long as you follow the rules and you have it available to you in the future when you meet certain criteria in retirement. To complement as well, retirement savings investing and smart use of debt, utilizing insurance to protect the lifestyle that you enjoy and the things and the people that are important to you, and ultimately having plans in place around your estate. And you'll recognize immediately, as I mentioned last time, things like will, healthcare proxy, powers of attorney, in some families' cases, trusts, all may be important to help protect and invest in your wishes today so that when life changes over time, your wishes are executed as you wish. And ultimately, as those intermediate and immediate needs are met as part of investing in your needs, other opportunities arise to invest in your future. And this is where we're talking about in the long-term brokerage accounts or investment accounts or taxable accounts that I will elaborate further on now. So as we begin with the investing process, I invite you in the same way we expanded our understanding of what financial planning is and financial well-being to include all those dimensions. I encourage you to expand your worldview of what investing looks like, inclusive of the markets and investments that we'll talk of shortly, and also in the intermediate term and immediate term, these other parts of your life where you're moving cash to help protect you and meet your needs so you have additional opportunities over time, now and in the future. With that, I'm going to take a quick sip of water and prepare to go a little bit further into the investing process. As we begin then, if we want to start the investment process, what are the strategies that I recommend all of us keep in mind? Using that same metaphor that Celeste and I brought up earlier, it's financial fitness, I thought let's start with 4 fundamentals. You know, in the same way we know for our physical health, it's good to eat well and exercise and have different activities that bring us joy. There are certain fundamentals for all of us, regardless of our investment goals or our investing why. The first thing that I think is important to consider is to define your investment objective. Now, different from, for instance, maybe going to a restaurant and being spontaneous around what we order, what really looks good that day on the menu, when it comes to investing, a certain amount of deliberation and intention is important. Because if you remember again, with the reality of risk, the reality that what you put in may not be there, and or it might go up and down quite a bit until you tap into it in the future. Beginning the process, it's important to understand for what purpose are you beginning the investment process? Is there a timeline around it? Are there people for whom you are investing? Are there specific activities that you're seeking to fund? Be as precise and clear as you can be. Step 1 of the 4 fundamentals is to say, I know that I'm interested in investing. This is the why. This is what I am trying to achieve by beginning the investing process. And to complement step 1, which is understanding your why, the second fundamental thing to keep in mind is to confirm your risk tolerance. Now, there are lots of different tools to do this, both online as well as when you begin the investing process, if you do it with others or perhaps through your employer. And what you're seeking to do here is through a systematic process of confirming things like your age, like how comfortable you are with the money that you're putting into your investment fluctuating over time, with understanding as things change, will your contributions to your investment change? Are you giving one time or are you giving multiple times? And if you're giving multiple times, over what period of time? What we're trying to understand here in this moment with Fundamental 2 is as you begin the investment process, how comfortable are you with the process so that in times like what we're experiencing right now with the markets, when there are highs and lows, you are sticking to Fundamental 1, your investment objective. So that when things are going up, you stay the course. When they're going down, you're staying the course. And the way that you get there and determine what the path is for you, it's through the identification and the confirmation of your risk tolerance. To complement your risk tolerance, what we then want to do is understand your investment choices and costs. And this will look very different investor to investor. So by way of example, if you work for an employer and that employer provides you the opportunity to be part of, say, a 401k plan or a 403b plan, what you'll want to do is you'll want to go through these 3 steps. If we take a step back, the objective for being part of that plan is to save money today for retirement. And if you're contributing pre-tax out of your paycheck, you are also reducing your pre-tax income. Fundamental 2. What you'll want to do is you'll want to understand through that employer retirement plan, how can you measure your comfort level with risk? Do they have ways for you to check how much risk is available in the investments and how comfortable you are with the process? And here in Fundamental 3, you want to understand what are the exact menu investment choices available to you and how much will it cost you? That's an example of how you can follow these first 3 steps if you're part of an employer retirement plan. Let's contrast this with, let's say you're a business owner, and let's say you have decided that you'd like to open your own retirement plan. Well, now your process is still the same, Fundamental 1. You're trying to save money today for retirement in the future by moving some of the income that you're earning into retirement savings and investing. Step 2, depending upon which organization you open up your retirement plan with, what you want to do is answer a risk tolerance questionnaire, confirming your age, your comfort level with risk, and with market fluctuations, how will things happen? So that step 3, you can look at the different investment choices available to you, what they will cost you, and then determine Fundamental 4, what your investment strategy is, and fine tune it as required. Now, as we lay out these 4 choices, the 4 fundamentals will be absolutely consistent across the investment decision you're making, whether you're investing for retirement, whether you're investing to pay for a trip in the future, whether you're investing to help pay for someone's college, perhaps in the form of a 529 plan. These 4 fundamental steps are absolutely the same and applicable to this investing process, regardless of the specific investment why you're choosing. You want to clarify your what, Fundamental 1. You want to understand your risk, your comfort level with the money you're putting in changing in value, and the money that might be available to you upon your taking out changing along the way. You'll want to understand the choices available to you and the relative price points. And lastly, you'll want to begin the investing process. And the key thing around this is evaluating it and checking it over time. And depending upon the type of thing you're investing for, the fine-tuning it as required may look different. For instance, if you're part of the first example, an employer retirement plan, where another entity is determining on an annual basis the list of and investment menu choices available to you to select from for your different investments, fine-tuning it might be a process you look at a couple times a year, or maybe once a quarter. If you are implementing an investment strategy yourself, because your investment objective, fundamental one, is saving for a trip in 2 years, and your risk tolerance, fundamental two, is low because you want that money there with a little bit of growth on it so that you have it, and you've, fundamental three, selected an investment choice with a little bit of risk at a good cost, then you might want to be checking it more regularly because you are monitoring the growth on the position and making sure it is behaving as you wish, because you want to be able to pay for that trip in a shorter period of time compared to the longer term retirement plan. So as we summarize, as we clarify and confirm what are the investment strategies that are important, as we begin the process, there are 4 fundamentals relative to everyone. We want to be clear about our investment why. What is our objective? Second, we want to be honest and transparent about our sensitivity to risk. How okay will we be if the money we put in may go away, or it might go up and down significantly until we want to use it for our objective? Third, we want to make sure we know our choices. What are the investments available to us, and what will it cost us to use them? And lastly, we proceed with intention, we implement our strategy, and we monitor it. And the frequency of our monitoring will vary based on, number 1, our objective. I'm going to pause here for a moment to take a sip of water before we continue with a few more strategies. If these are the fundamentals then, and we're thinking of this as strengthening our financial fitness through investing, what else is important? What I'd love to share with you now, given those 4 fundamentals, are strategies or 5 principles that are critical for every investor to keep in mind as she begins the investing process. So you've gone through steps 1 through 4 in the same way each of us know we have to eat healthy and exercise and do some mental work to be okay with our health. Here is the next level. We're not just exercising, we're exercising regularly. We're not just eating healthy, we're trying to eat healthy 80% of the time. Now that we're deciding that we are investing, these are 5 principles that we want to follow as part of the process or keep in mind. The first principle is that diversification matters. And when it comes to investing, you have an abundance of choice, or different assets and different ways you can deploy your cash and your money. And the way I like to frame this, given the universe of choice available, I like to break it down simply for the purposes of our discussion today into 3 areas, just in this moment: stocks, bonds, and cash. So if we think about the investing process as general statements with a lot more detail underneath them, stocks is ownership in something, bond is a loan for which you get principal payments, and cash, as we all know, is readily available for day-to-day. When we talk about the investing process, many people begin the process thinking about, on the far left side of the page, all stocks or only stocks. The idea being that in exchange for the cash they have today, they're focused on growing or building wealth. They move their money into the ownership style of investing, which are stocks, and they look towards stocks for growth. The general thought is typically, though not always, stocks and bonds behave a little differently, with stocks being a little bit more risky and bonds theoretically being a little bit less risky. and cash having the least risk of all. The risk to cash is inflation, where cash doesn't keep up with the prices that we're all paying at the store. If you think about it, if you take what you have as cash and put it only into stocks, you're not diversifying. You're simply moving the form of what you have. You're moving cash into the form of stock. The second pie chart that you see here shows a little bit more diversification. You're having some cash you're retaining, and you're dividing the additional funds that you previously had as cash into the two categories of stocks and of bonds. And in this example, only US large stock and US bonds. While this is more diverse than only stocks and more diverse than only cash, it still is subject to being even more diverse. If you see on the far right-hand side of the page, you can diversify further your stock into geography, US versus international versus emerging market. You can diversify your stock according to size, large cap versus mid versus small. You can diversify it according to sector, so that you have specific areas and industries that you're exposed to. In the same way with bonds, you can have different types of bonds that you can buy, whether they're corporates or companies or preferred, they have different treatments, or municipals from government. The key takeaway here is that if you've completed those first fundamental steps as part of the fundamental process of starting the investment process, the first of the 5 principles says, if you're going to invest, make sure you diversify what you're investing, because diversification matters. And how important is diversification? What you see here on this page is a colorful quilt. It is not a quilt of just colors to look visually appealing. What it is, if we look at it from left to right, and this is courtesy of JP Morgan, is at the top of the page, we see different columns. We see from 2007 all the way through till year to date, YTD. And then within each column, each color that we see represents a different style of asset or investment. And what we see with regard to the column is the asset or the investment that did the best is at the top, and did the worst is at the bottom. And a key thing you see right away is you scan this, and this is a reflection by year from 2007 through this year to date, and this was through March of this year, that from top to bottom, those assets that did really great compared to those assets that did not, there seldom is one that is always in the top. And there is seldom one that's always in the bottom. You see the color scheme changing. Sometimes orange is on top, small cap. Sometimes orange is on bottom. You see large cap green on top, but you also see it towards the bottom. The takeaway from this is that at any given time, what we invest in may be up, at other parts of it being down. And where we have a combination of exposures, a combination of different types of stocks and bonds, like I mentioned earlier, this white box, it's generally in the middle. It generally, when we have the diversification, is not at the very top, the outperforming, nor is it at the very bottom, the lowest performing. It's in the middle. And this style of diversification provides a level of cushion and level of consistency is the vision. That's the value of diversification over time. When you're investing, seeking a variety of different exposures, expecting that any given time something will be up and something will be down, so that over time you're trying to have a consistent quality level of growth. That's principle 1 of 5 when it comes to the investing process. What's principle 2? Principle 2 talks about dollar cost averaging. Dollar cost averaging is the idea that you don't pay for everything all at once. You spread it over time. So what you see in this table, by way of example, is somebody's decision to say, I would like to buy something and I have $100 that I'm willing to spend every single time for a total of $400. And what you see here is that each time that person starts to save or invest that $100 in the second column, as markets go up and down, so do the prices for what that $100 will buy of that unit that the person's buying. At one point, it might be $1. At another point, it might be on sale for 50 cents. Another point back up to $1, and then maybe it's at a premium of $2. As a result of those prices fluctuating, there's a different number of shares or units that the investor purchases. And here's what you see, the power of dollar cost averaging. Over time, as the individual consistently puts $100 to work in the market by buying the money, she builds the total number of shares of her account. And while the account value continues to grow, $900 in this case, because that's 450 shares in her account, valued at $2 a share at the last point in time, her average price, as you see at the bottom of the screen, is just over $1. 1.125 was the average price for the shares, but the average cost to this investor was 89 cents, given how much she paid for the shares that she purchased. Why is dollar cost averaging important? And why do I bring it up as the second of 5 principles? Dollar cost averaging is a strategic way to put money at work on a regular basis, especially when one of 2 circumstances exist. The first circumstance is like right now, when the markets are very volatile, because you never quite know at any given time, is the price we have right now most expensive or is it least expensive? It spreads the risk by spreading the time at which you're putting the dollars to work. And the second circumstance where this is super strategic is when you are just beginning the investment process. So you're putting cash to work, or you might have been previously invested in less risky positions and you're taking on a little bit more risk. It's a way to put money to work that previously wasn't invested and or taking on additional calculated risk when you had less risk that you were carrying. It spreads the risk and the how over time. That's why this is a second principle that's important to keep in mind as part of the investing process. I'm going to pause for a minute for a sip of my water and invite any questions in the chat or in the Q&A, and then we'll continue. Seeing none, let's press on together. We've talked so far about the importance of diversification. We're spreading the type of risk we're going to take on. Dollar cost averaging says when we're going to take on and purchase our shares and purchase our investments, we're going to spread it over time. The third principle I'd like to highlight to you is the power of compounding. And so this one it's kind of fun to see visually. It's the idea that when you're investing, you are earning not only the original interest on what you originally put in, said differently, the principal, your original payment in, but as your investment grows, you're additionally benefiting from earnings on the interest that you earned along the way. So said differently, in compounding, you earn not only on what you originally put in, but on the additional layers of growth and return that you get as the investment grows over time. And here's how you see it depicted visually. Let's say someone began the investing process, and this is purely for illustration only, because if it were this easy, we would all be investing pennies every day of the week. The idea is if you take 1 penny and you were to invest it, compounding would say, in return for that principal of that penny, you get another penny. So on the third day, you have the original penny you put in, plus the interest or the compounded penny. And now you get those two pieces multiplied by two more pennies. This continues day by day. Those 4 pennies become 8 cents, become 16 cents. Do you see how what you put in, you get a little more added on to, and then a little more is added on to that each day through the process. This visually adds up to, theoretically, over $10 million. Now, this is not exactly how it actually works in the markets, because we would all be investing pennies every day, like I said. But what it does is it illustrates a fundamental investing principle that as part of the investing process, when you invest and growth happens, you not only get return on the money that you put in, there you get the return, but that return that you earn plus that original principal also benefits from additional returns over time, compounding or amplifying the amount that you earn through the investing process. This is a super powerful feature of investing that is extremely important to keep in mind at any time with investing, and especially when things are volatile. To complement this third investing principle, the fourth one I would invite you to consider is to invest and keep the long-term view in focus. And this is a very helpful illustration that depicts across time at the bottom. So since 1996 through January 31st of 2002, and on the left-hand side of the graph, the actual value of one market index, the S&P 500 price index, how the different markets performed as and when different life events happened. So you'll see here, for instance, that there had been growth in the markets. If we go from left to right, at any given point in time, the gray shows the actual return. And as we all know, there are ups and downs, not only every day, but within every day, throughout the day, at multiple hours of the day, and even in multiple minutes, up and down, up and down, up and down. And you see the progression from 96 to 2000, where then we had a bit of the tech boom. And then the market struggled, and then they came up again, up through then the recession. Recession hit 07, drop again. But then we recovered from 2007, up to 2020. Then we dropped significantly with COVID, over 30% in one day. Then we grew, recovered up through January 31st of 2022. I highlight this to you not to minimize the significance of these major events that happen around us and that impact the market activity. I highlight it to demonstrate the importance and the value of staying invested. If someone had left the market when the market was going down at any one of these points in time, she would miss out on the compounding effect we just talked about of the money that she had in there, growing, and making more as the markets recovered. You know, it's interesting, parallel for this, because some people will say, oh, Carolyn, it's scary for me. You know, I'm nervous because I don't understand how volatility is going to affect my life and my finances. And I invite you to think about this similar metaphor. How many of us know the true number of injuries and casualties that come out of car accidents every year? I dare say that I don't know, and I don't want to know, because there's so much volatility and challenge and inherent risk that comes every time we sit behind the driver's seat. But the trade-off is, if we refrain from getting into the vehicle to move from place to place, we would miss out on the reward of time with other people, of jobs that generate income, all of the benefits of mobility. While this is an extreme and an exaggerating metaphor, I offer this to you as well for the investing process. Yes, there are risks. And yes, there are times like right now where there are dramatic fluctuations in value. That's why it's so imperative that when we begin the investing process, we start with the fundamentals, those 4 that I talked about earlier: our why, our risk tolerance, our choices, costs, and our plan. Because when the volatility inevitably happens, because it will, it's essential that we stay invested and keep focused on the long term to benefit from the diversified exposures we have, the compounding growth, and over time so that we can achieve our goals. So in sum, I invite you with this additional component of focusing on the long term. This is the 4 of 5 principles of investing, not to minimize the volatility that happens. This will happen, but to expect it, anticipate it will be part of the investing process. And as part of the investing process, have a realistic long-term view of what you're doing and why, so that you can navigate through the uncertainty and proceed forward with your goals. I'll take one more sip before I'll transition shortly to the 5th principle. All righty. What is our 5th principle? The 5th principle is an honest self-reflection. When it comes to the investing process, you have choices. There are a variety of different ways that any one of us can begin the investing process. And what you see laid out here is what I like to describe as a control continuum. On the left-hand side of the page is a low level of involvement, research, diligence, responsibility on your part, in contrast to, on the far right-hand side of the page, a high ongoing level of responsibility on your part in order to make the investing process happen and work, with medium being in between. So when we think about the investing process, I think it's essential, if you're going to do this over the long term, to have an honest, practical conversation with yourself. Do you have the time, the energy, the interest in going through and understanding the different investments available to you, the prices, and their different coordinated returns, to be responsible fully and solely and independently for the investing process? Or if not, how much of it do you want to share with somebody else or an entity that you trust to be part of the process? On the left-hand side of the page, if you say to me, you know what, I want very little involvement in this process, and I would like to have a structure, systematic way to just get investing, then you may want to consider online tools developed and offered by fiduciary organizations, where you can go in with your investment objective in mind, fundamental 1 of the 4 fundamentals, open up an account based on your risk tolerance, answer questions around your risk tolerance, then be invested according to your goals and understand your choices, and effectively set it and forget it. It's an online investment portfolio structured according to your goals and your risk, and you know that the investing process is covered. Key here, look for fiduciary, your best interest, as a provider of those services. The far right-hand side of the page, and many investors like this, they welcome it, they want it, would be develop and implement your own investment strategy, looking at all of the performance numbers, understanding the trade-off between large cap value, large cap growth, and determining the right mix for you in light of the projected 12 months and 3-year horizons. That is where you fully own it independently and you make it happen. And in the middle is where you may want to consider engaging a fiduciary professional like me, where you work with someone to identify what are your goals, what is your risk tolerance. That professional offers you an investment strategy and plan that you then pay that individual to manage on your behalf as part of your ongoing process. That middle level of responsibility or involvement requires some upfront work with you and that fiduciary professional, but then over time, you effectively authorize or hold responsible that professional to do it for you and keep you updated on the progress along the way. So simply know the 5th principle is a very real acknowledgement that when the investing process happens, There are lots of different ways that you can approach it. Depending upon your energy, your time, your expertise, and your interest, you may take a high degree of control over the investing process, or you may choose to delegate portions of it or all of it to others. And here's with my bias as a fiduciary, I recommend look for a fiduciary partner to serve you. So as we prepare to wrap up shortly, let's look at these investment strategies put to action. We had 4 fundamentals and we had 5 principles. Fundamental 1, know your investing why. What are we investing for? 2, know your risk tolerance. 3, know your investment choices and costs. And 4, proceed with the investment process, checking and monitoring your progress over time. And since we've started the investing process, we're going to strengthen it further with 5 principles. Dollar cost averaging, putting cash to work in a systematic way. We want to diversify what we're doing at all times to spread the risk. We want to benefit from compounding, stay invested so that not only our principal, but the interest on our principal both is subject to additional growth. We want to keep a long-term focus. We know things are going to be volatile, and we have clarity around the extent to which we do this ourselves, or we ask the fiduciary assistance of others. Here you see this all laid out with 4 interesting personalities. If we assume in this example that 4 different people saved $200 a month and they did different things to it, how did it serve them in the end? Consistent Chloe, she's the blue line we see first. She attended this presentation with Celeste in New Haven Free Public Library and I've Squared and Me right when she was 25 years old. She heard the fundamentals, she heard the principles. She started investing $200 a month on a monthly basis in a diversified portfolio that overall earned around 6.25%. She saved that $200 monthly from age 25 to 65. She invested a total of $96,000. And with some assumptions around that growth, look at what her ending portfolio resulted in by the time that she retired at 65. It was over $420,000. $200 a month, slowly, methodically, over 40 years, $96,000 total. Congratulations, consistent Chloe. Let's look at what Lila did. Lila was on the same webinar with Celeste, New Haven Free Public Library, I've Squared and Me, but she just happened to be 35 rather than 25. She also listened closely. She didn't have that first 10 years of contributions that consistent Chloe had, but she had a good 30 years of contributions, a total of $72,000 she put to work from age 35 to age 65. And you follow her purple line, she earned in her portfolio, assuming regular linear returns every year, of over $210,000. The key mention here, the key takeaway is investing early. The earlier you start, the better it serves you. So regardless of where you are now, consider starting the process. And here's an example. Quincy was part of our experience as well. He started saving and investing at age 25 in that diversified portfolio as well, but he got distracted. He did this for 10 years and he forgot to stay in touch with Celeste, me, New Haven, and I've Squared. And he stopped his savings and investing. His $24,000 that he put to work for the first 10 years early on in his life actually grew to nearly $210,000, $209,600. And that reinforces the strategic principle of the early process. Had he continued it sustainably, regularly, he could have benefited from even more growth. Chloe, Lila, and Quincy's positive returns are in contrast to nervous Noah. The great news is Noah did save, and that helps Noah have available not only emergency reserves, but some cash cushion. The challenge is his nervousness undermined his financial choices and limited his ability to manage inflation. He put his money into cash earning around 2%, He did this for 40 years, from age 25 to 65. That $96,000 total in 40 years yielded only $147,900. What this reinforces is that savings is important, and it reinforces that global diversification with the intention for growth and spreading risk. So key takeaway, to complement those 4 fundamentals: know your investing why, confirm your risk tolerance, understand your choices and costs, implement a strategy and fine tune it, and additionally, diversification matters, consider dollar cost averaging, remember the power of compounding, keep that long-term focus in mind, and be clear about your level of involvement, you can see how this all can work to serve you today and over time. And speaking of time, this is the right time, I think, to pause and say thank you for your engagement. Thank you for your participation today. What we've done as a group is we've reviewed again what financial health and well-being looks like. We talked about the essential ways around investing in you in the immediate term emergency savings, in the intermediate term, protecting your needs and wishes, whether it's from strategically using debt, saving and investing in retirement accounts, having in place the appropriate insurance policies to serve you, as well as your estate planning needs. And then in the long term, through the strategic investing process. And then, as we have said a few times, the 4 fundamentals and the 5 investing principles. I hope that you have enjoyed learning about these investing strategies for success. And if at any time you'd like a complimentary consultation, let me know. Would happily receive your feedback to the survey that's in the chat, and would always welcome any questions anytime. Thank you again, Celeste, New Haven Free Public Library, I2Squared, and all of you today for this opportunity to share this with you. And join us for our next one and final one next week.
Thank you so much, Caroline. I think it was really, really helpful. We have some viewers in Facebook, and we have about 12 participants in Zoom. So that was great. All right. So see you next week, and thank you, and enjoy the week.
Thank you.
Thank you. Bye-bye, everyone.